These days, we hear a lot about smart investors and their many financial strategies. However, that doesn't mean that millions of millennials already have a wise investment plan. And that's a problem since over the next decade or two, millennials in the US will receive around $30 trillion, making this the largest generational wealth transfer in American history. Additionally, the COVID-19 pandemic's effects and potential changes to state tax laws could speed up this process, which would mean they would have a lot more money but not necessarily understand how to use it effectively, which is why it's crucial to comprehend and put the greatest financial strategy in place. But really, do you know what qualifies as a smart investor? And what actions must be taken before you can be called one? These are some of the topics we'll be discussing today, so sit tight and make sure to watch video until the end. How to be a smart investor? Let's first analyze what the term smart investor means. Instead of focusing on making a lot of money quickly, a smart investor uses the resources at hand to make regular investments that diversify their portfolio and build wealth over time. You might be surprised to learn that wise investors don't put their money where everyone else puts it. Instead, they educate themselves about the market and do in-depth research before making an investment. This is why renowned billionaire Warren Buffett is known as the wealthiest investor today with stocks and over 40 companies in the world. Warren Buffett is what you'd call a very smart investor. His investment strategy changed to investing in inexpensive, well-managed firms, and he now tends to stick onto the stocks he buys for the near future. Given that Buffett is one of the wealthiest people today, you could say that he is a financial genius. If you were to make a list of today's smartest investors, you'd be crazy to leave Buffett off of it. If at all possible, start investing early to gain an advantage. After all, the optimum moment to start investing was yesterday. So let's look at some ways you might achieve this. Being a smart investor like Warren Buffett is difficult, but it is attainable. As Warren Buffett says, the secret to great investing is to wait. The next best thing is now you should also be consistent with your investments. By this, we don't just mean investing once a year, but instead investing a set amount each month or quarter. Only by doing this you'll be able to keep your financial discipline and accomplish your financial goals. Having a diversified portfolio should be the next item on your list. Do you remember the old saying, never put all your eggs in one basket? It is still true today. We all know that investing has its own set of risks, but if you have diversified your investments, you won't feel the pressure of these risks. We assure you that having different investments can help you to avoid some extreme financial losses in the case of a volatile market. We assure you that having different investments can help you to avoid some extreme financial losses in the case of a volatile market. Building a risk appetite is a crucial step to take as a financial investor. Yes, we all know that the purpose of diversifying your investments is to manage your risk, but every investment carries some level of risks, and being an investor means you must be willing to do so. Just to be clear, you should measure the level of risk you're willing to take. Knowing your financial loss threshold and your tolerance for volatile markets is crucial because it will help you secure your financial future. Finally, you should educate yourself and be patient. Don't forget that good things come to those who wait. At least, this is a common proverb that most people are familiar with. And funny enough, this adage also applies to the financial world. Don't be in rush into the stock market in an attempt to quickly benefit from it. Although what we've just said may sound simple, you will find that even the best investors make mistakes and end up regretting them, including the great Warren Buffett. Despite his investing prowess, doing so casually would be equivalent to wasting your money. However, if you make it a habit to learn something new about investing every day, it'll pay off in the long run. Buffett has made his fair share of investing blunders and is unable to predict the future from a tarot card or a tea leaf. You might be surprised by what Warren Buffett regrets when it comes to investing. One of his regrets stems from investments we might see as solid, but the man himself feels he could have done better, and he might be right. Over the years, Warren Buffett's investment regrets. Let's take a look at a few. Once you've been in the game for a while, you're bound to make some losses. Did you know that Buffett declared that Berkshire Hathaway is the first example we'll discuss? Was his global firm, which is now worth $42.5 billion, the worst investment he had ever purchased? Indeed, we initially believed the man was joking until we learned the obvious explanation for the comment from the 1960s. While he did turn things around, Buffett's decision to purchase stock in Berkshire Hathaway, despite the fact that it was a failing company, was not one that was based on careful consideration. Later, when the owner tried to chisel him out of more money by trying to buy the stock back from him, Buffett snapped and bought more of the company stock. So I guess you know what lessons to take from this. Never let emotions control your investing decisions, and there are other investment regrets he's had, such as not investing in Amazon early and not investing in Google. This just goes to show that nobody is perfect and we can't win all the time. Top financial strategies to use right away. It's time to talk about some of the most effective financial strategies employed by smart investors. We've already given you some advice, but now we'll finish things up with these strategies since we firmly believe you'll be using them for decades to come. First, maintain your investment strategy. There is a well-known investment maxim: trade your plan and plan your trade. It basically implies that you should understand why you're investing in a business before spending any money in it. It's also important to adhere to your plan after buying a stock, and you should avoid getting emotionally involved in your trade. Second, don't time the market. A mistake you can make as an investor is trying to chase performance. Even the best managers occasionally perform poorly. In order to generate profits by timing the market, investors must be able to read the market at an almost psychic level, but this isn't a useful solution according to efficient market theory, and we agree with that theory. Prioritizing time spent in the market by buying and holding high-quality stocks is significantly less likely to provide huge short-term gains. Third, be more careful and avoid from betting down. We're all aware that investors occasionally make poor decisions, but it shouldn't lead you to invest more money in a losing investment. If your research was inaccurate and the stock falls rather than rises, you've made a mistake. Doubling down on a stock in the hopes of recovering your losses is a wasted vote assumption and amounts to additional money being wasted. Even though it can occasionally be profitable, the strategy is more comparable to a lottery trick than an investment one. That's it for today. Ladies and gentlemen, since you stayed, here's a fun fact. Be cautious and don't let previous failures affect your future judgments. Did you know that there is an investment strategy that basically revolves around going against the current? It's called contrarian investing, and it's famously associated with Warren Buffett's quote, "Be fearful when others are greedy and greedy when others are fearful." You